7 High-Yield Covered Call ETFs Income Investors Will Love by Tony Dong. According to ETF Central's screening tool, the U.S.-listed exchange-traded fund ETF universe numbered 4,453 as of August 18th. Of these, 695, or about 16%, are classified as options-based strategies. These alternative ETFs go beyond long-only stock exposure, using call and put options to hedge against declines or generate income. The latter is far more common, with covered call ETFs representing the most popular variant. Covered call strategies trade away some potential upside in exchange for above-average income. A typical example is an ETF tracking the S&P 500 that sells call options on the index, producing monthly cash flow but limiting gains if the market rallies. The challenge is ensuring the yield is not only tax-efficient, but also compensates investors fairly for lost appreciation. Key factors include the time to expiration, coverage ratio, the portion of the portfolio overwritten with calls, the moneyness of the options sold, and underlying market volatility. None of these variables operates in isolation, and issuers mix and match them in different ways. This flexibility has fueled the rapid growth and variety of covered call ETFs available to investors today. With a covered call ETF, the stock purchase, portfolio management, and call writing decisions are left to a professional, says Robert Johnson, professor of finance at Creighton University's Hyder College of Business. By buying a covered call ETF, one does not have to continuously monitor both the stock and options markets. Here are 7 of the best covered call ETFs to buy right now. JP Morgan Equity Premium Income ETF JEPI. JEPI is the poster child for covered call ETFs. With more than $40 billion in assets under management, it is not only the largest covered call ETF, but also the largest actively managed ETF overall. Its unique approach comes at a hard-to-beat 0.35% expense ratio, which is highly competitive for active management and derivatives use. It even has its own investor community on Reddit. JEPI builds its portfolio from low volatility, defensive mid, and large-cap U.S. stocks that differ significantly from the S&P 500. At the same time, it monetizes S&P 500 index volatility by dedicating about 15% of assets to equity-linked notes, which replicate the payoff profile of a one-month, out-of-the-money S&P 500 covered call strategy. Currently, JEPI delivers an 8.4% distribution yield. JP Morgan Nasdaq Equity Premium Income ETF JEPQ. The strategy behind JEPI is designed to be defensive. Its core of low-volatility stocks lowers beta, while the covered call overlay cushions small declines by generating income. But investors prioritizing maximum income may find JEPI too conservative. A viable alternative is its smaller $29 billion counterpart, JEPQ, which also carries the same reasonable 0.35% expense ratio. JEPQ employs the same two-part approach with some variations. It actively selects stocks but keeps its composition closer to the Nasdaq 100. Like JEPI, it uses equity-linked notes for about 15% of the portfolio, but these are tied to one-month, out-of-the-money covered calls on the Nasdaq 100. Because the Nasdaq 100 is more volatile, JEPQ delivers a higher 10.6% distribution yield. Global X Russell 2000 Covered Call ETF RYLD. Not all covered call ETFs are actively managed. Some, like RYLD, take a passive approach. RYLD tracks the SIBO Russell 2000 by Right Index, which combines a long position in Russell 2000 stocks with one-month, at-the-money call options written on 100% of the portfolio. Unlike JEPI and JEPQ, the focus here is squarely on small-cap stocks. The ETF charges a 0.6% expense ratio. The higher volatility of small caps, combined with the fund's use of full coverage at-the-money calls, produces a very high 11.8% distribution rate. However, upside appreciation is severely capped because any gains above the strike price are surrendered to option buyers, leaving investors with limited growth potential beyond the income stream. As with JEPI and JEPQ, RYLD pays monthly distributions. Roundhill Bitcoin Covered Call Strategy ETF YBTC. Covered call ETFs are not limited to stocks. By using an ETF of ETF structure and index options, investors can generate income from bonds or even cryptocurrency. A good example is YBTC, which pairs exposure to iShares Bitcoin Trust ETF IBIT options with SIBO Bitcoin US ETF Index CBTX options. This combination produces weekly income from what would otherwise be a non-cash paying asset. Because Bitcoin is extremely volatile, YBTC is able to deliver a strikingly high 37.1% distribution rate. However, selling covered calls means investors give up much of Bitcoin's upside potential. YBTC should be viewed as a way to hold crypto while harvesting gains as income rather than relying on price appreciation. The yield is also subject to fluctuation depending on how Bitcoin performs. NEOS Real Estate High Income ETF IYRI. Real estate investment trusts, or REITs, already produce high yields since they are legally required to distribute at least 90% of their taxable income. Investors can enhance those yields further with a real estate covered call exchange-traded fund like IYRI. This fund holds a portfolio of REITs that mirrors the Dow Jones U.S. Real Estate Capped Index, while selling covered calls on the iShares U.S. Real Estate ETF IYR. A key distinction for IYRI and most of NEOS's covered call ETFs is its tax efficiency. By tax loss harvesting individual holdings, the ETF can classify a larger portion of its distributions as return of capital. IYRI currently pays an 11.1% distribution rate, and NEOS estimates that 87% of its most recent monthly payout will be a return of capital. However, the final tax treatment is determined at year-end. Amplify CWP Enhanced Dividend Income ETF DIVO. DIVO is a prime example of why investors should not judge covered call ETFs by headline yields alone. Its current 4.9% distribution rate may look modest compared to peers, but DIVO has delivered strong total returns. It carries a 5-star Morningstar rating, having outperformed most derivative income ETFs on a risk-adjusted basis, while also beating the SIBO S&P 500 by Right Index since inception. Unlike most index-based covered call ETFs that write calls robotically at set times, DIVO's actively managed approach not only allows the manager to monitor holdings each day to ensure they meet quality and valuation metrics, but it also provides the flexibility to take advantage of timely opportunities by writing calls on individual stocks, says Christian Magoon, CEO of Amplify ETFs. Amplify CWP International Enhanced Dividend Income ETF IDVO. The success of DIVO prompted Amplify ETFs and its sub-advisor Capital Wealth Planning CWP to expand the lineup. IDVO is the international version, offering exposure to non-U.S. stocks screened for strong earnings growth, free cash flow, dividend growth, and return on equity. Covered calls are then written on individual holdings at CWP's discretion to generate income while retaining some upside. IDVO owns high-quality, dividend-paying international stocks while maintaining the ability to tactically write covered calls on individual stocks, Magoon says. Foreign stock exposure will further diversify a U.S. stock portfolio and perhaps increase total return potential. The ETF pays a 6.1% distribution yield and charges a 0.66% expense ratio, slightly higher than the 0.56% charged by DIVO.